Listen up, this ain't just gold and silver moving a couple bucks. This is Washington shaking the table and the market flinching in real time. Supreme Court drops a ruling, Trump fires back with a 15% global tariff, dollar swings, metals spike. That's not random, that's power shifting. And while price pulls back, the real money keeps stacking. You think this is over? Nah, this is the setup. Stay with me. And hey y'all, if you see me as your brother, your friend, then show some love. Hit that like button, tap subscribe, and drop a comment telling me where you're watching from. I really want to see which part of the country is tuning in. Let's build this community strong. This is not a routine metals update. This is a cross-asset stress signal forming in real time. Gold and silver just printed their strongest surge in 3 weeks, and the move did not come from nowhere. It came from policy shock, it came from legal intervention, it came from geopolitics tightening at the margin, and price reacted fast. In the United States, spot silver is trading roughly between $28 and $30 per troy ounce, about $900 to $950 per kilogram, linked directly to international benchmarks including COMEX and updating live with every shift in macro tone. That is the surface. Underneath, the structure is shifting. The United States Supreme Court ruled that the reciprocal tariffs imposed by President Donald Trump are illegal. That ruling weakened the US dollar. That ruling triggered repositioning. And in response, President Trump announced a flat 15% global tariff on all trading partners. This is not a headline, it is a mechanism. Legal reversal, policy replacement, immediate recalibration of trade assumptions. At the same time, uncertainty around talks between the United States and Iran added another layer of caution across global markets. Safe haven demand responded. Gold and silver surged. On Monday, silver jumped 15,000 rupees per kilogram in the spot market to 265,550 rupees per kilogram. Gold gained 3,362 rupees to 158,128 rupees per 10 grams. That was the sharpest weekly gain in 3 weeks. The US dollar weakened after the Supreme Court decision. Metals advanced. Price reflected the shock. Overseas, gold futures on COMEX climbed $96.61 per troy ounce to settle at $5,177 per ounce. Silver futures rose 58% to $86.93 per ounce. Momentum was real. The move was broad. But it did not persist. On Tuesday, gold declined as traders locked in gains after a rally of more than 2% in the prior session. The US dollar strengthened, bullion softened. Spot gold fell 1.2% to $5,167.28 per ounce by 0538 GMT, ending a 4-day advance after touching its highest level in more than 3 weeks earlier in the session. Earlier in global trade, spot gold slipped 1.5% to $5,150.38 per ounce as of 0125 GMT. Spot silver retreated 3.1% to $85.50 per ounce after Monday's rally pushed it to a 2-week high. On the multi-commodity exchange, April 2026 gold futures declined 983 rupees, or 0.55%, to 1,60,615 rupees per 10 grams. Silver futures for March 5, 2026 delivery slipped 1,006 rupees, or 0.3%, to 2,64,327 rupees per kilogram. Exchange-traded funds followed price. Gold and silver ETFs fell by as much as 3%. Grow Gold ETF, SBI Gold ETF, and HDFC Gold ETF each dropped about 3%. UTI Gold ETF declined roughly 2%. Most silver ETFs recorded losses around 1%. Analysts cited profit-taking. Zion Vauda of Market Pulse by Oenda pointed to selling after prices surged to roughly $5,249 per ounce. He also noted that the fresh 15% tariff announcement may have offered short-term visibility on trade policy. That is the tension. Policy shock drives metals higher. Clarification caps momentum. The market is oscillating between uncertainty and temporary visibility. Gold remains a traditional safe haven. On Monday, the US dollar slipped marginally against a basket of currencies. Bitcoin dipped below $65,000 but remained above its earlier monthly low. Gold extended higher during that window. But here's the structural layer that cannot be ignored. According to Motilal Oswal Financial Services, official sector demand has become a structural pillar, not a tactical trade. Central banks have net purchased around 1,000 tons per year for 4 consecutive years through 2025 and into early 2026. That is not noise. That is structure. Emerging market and middle-income economies are diversifying reserves in response to geopolitical and fiscal pressures. Poland, Kazakhstan, Brazil, India expanded holdings. The report also cites substantial but opaque accumulation in China and Russia through domestic channels. Consistent buying, year after year. This steady central bank demand has supported gold even during volatility. So we have 2 layers operating simultaneously. Short-term positioning driven by dollar strength, tariff announcements, and profit-taking. and long-term structural accumulation by central banks. Price reflects what is known, risk reflects what is building, the Supreme Court decision, the 15% global tariff announcement, ongoing uncertainty around US-Iran talks, dollar fluctuations, ETF outflows, profit-taking, and beneath it all, persistent central bank demand of approximately 1,000 tons annually for 4 years. The market has reacted to the headline, it has adjusted to the dollar, it has priced the immediate tariff response. But the broader trade architecture remains in transition. Legal challenges may continue. Policy clarity may take time. That process is not resolved. That process is ongoing. This is not about panic, it is about alignment. Watch the US dollar trajectory. Watch futures positioning on COMEX. Watch ETF flows for confirmation or divergence. Track central bank purchase data for continuity versus slowdown. Monitor developments in US tariff policy and diplomatic signals between Washington and Tehran. The metals complex is not moving randomly. It is responding to policy mechanics, currency shifts, and institutional allocation decisions. The volatility returning after the strongest weekly performance in 3 weeks is not contradiction. It is compression. It is the market recalibrating. And until trade policy, legal outcomes, currency direction, and geopolitical negotiations settle into a stable configuration, gold and silver will continue to trade at the intersection of uncertainty and structure. This is not just price action. It is a live read on confidence, reserves, and global policy alignment. Stay focused on the mechanisms. Stay focused on the flows. The signal is there. Part 2 begins where the surface volatility ends and the structural bid becomes impossible to ignore. The short-term narrative says profit-taking. The tape says dollar strength, futures pulled back, ETFs slipped, spot gold fell to $5,167.28 per ounce, and then to $5,150.38 per ounce. Spot silver dropped to $85.50 per ounce after touching a 2-week high. On the MCX, April 2026 gold futures eased to 1.60,615 rupees per 10 grams. Silver futures for March 5, 2026 delivery declined to 2.64,327 rupees per kilogram. That is what price is doing. But that is not the full picture. Underneath the daily fluctuation sits a 4-year pattern of central bank accumulation averaging roughly 1,000 tons per year through 2025 and into early 2026, according to Motilal Oswal Financial Services. That is not tactical buying, that is reserve strategy. Poland, Kazakhstan, Brazil, India, expanding holdings, China and Russia, accumulating through domestic channels with less transparency. This is not a headline, it is a mechanism. Diversification away from concentrated reserve exposure, reinforcement of balance sheets against geopolitical and fiscal uncertainty. The Supreme Court ruling against the reciprocal tariffs imposed by President Donald Trump triggered a dollar reaction. The subsequent announcement of a flat 15% global tariff on all trading partners introduced short-term clarity, but did not eliminate structural uncertainty. That distinction matters. Markets trade clarity in the moment. Institutions allocate against uncertainty over years. That is the disconnect. ETFs falling by up to 3% in a single session reflect positioning adjustments. Central banks buying 1,000 tons annually reflect policy doctrine. Price reflects what is known. Risk reflects what is building. Add to that the geopolitical layer. Uncertainty around United States-Iran talks persists. The US dollar moves session to session. Bitcoin briefly dipped below $65,000, yet remained above its earlier monthly low. Cross-asset signals are mixed, not chaotic. This is not disorder. It is repricing under evolving trade architecture. Profit-taking after gold approached roughly $5,249 per ounce explains the immediate pullback. Dollar firmness explains pressure. But neither explains the sustained multi-year official demand. That demand has provided resilience during volatility and absorbed supply during corrections. The market has processed the rally. It has processed the pullback. It has not fully resolved the policy transition underway. Watch 3 things going forward. First, whether central bank net purchases maintain the roughly 1,000-ton annual pace. Second, whether ETF flows stabilize or continue reflecting short-term sensitivity to the dollar. Third, how the US dollar behaves as tariff policy evolves under legal scrutiny and implementation. This is not about forecasting extremes, it is about tracking alignment. When policy uncertainty rises, metals respond. When clarity appears, momentum pauses. But the structural bid from official sector demand remains the anchor. That is not noise, that is structure. And until trade policy, currency direction, and geopolitical negotiations settle into durable equilibrium, gold and silver will remain instruments of macro positioning, not just commodities reacting to headlines. As trading activity progressed through the session, international price movements continued to reflect a market balancing recent gains with emerging headwinds. In global markets, spot gold declined by 1.5% to $5,150.38 per ounce as of 0125 GMT. This movement followed an earlier advance, during which the metal had touched its highest level in more than 3 weeks. The shift underscores the rapid adjustments taking place as investors respond to currency strength and policy developments. Spot silver also moved lower in global trade, sliding 3.1% to $85.50 per ounce. The decline came after a strong rally on Monday that had lifted silver to a 2-week peak. That earlier advance had been part of the sharpest weekly gain for both gold and silver in the past 3 weeks. The reversal highlights the impact of short-term profit booking and currency fluctuations on precious metals pricing. On Monday, both metals had recorded significant gains in the domestic spot market. Silver prices had surged by 15,000 rupees per kilogram, reaching 2,65,550 rupees per kilogram. Gold had climbed by 3,362 rupees to 1,58,428 rupees per 10 grams. The rally followed a weakening of the US dollar after the United States Supreme Court struck down President Donald Trump's reciprocal tariffs. The decline in the dollar provided support to bullion, as a softer U.S. currency generally makes dollar-denominated commodities more attractive to buyers using other currencies. In overseas futures trading on COMEX, gold futures rose by $96.61 per troy ounce to $5,177 per ounce. Silver futures recorded a gain of 5.58%, reaching $86.93 per ounce. These increases contributed to the strongest weekly performance in 3 weeks for both metals. However, the subsequent strengthening of the US dollar and renewed selling activity moderated prices in the following session. Analyst commentary pointed to investor behavior as a key driver behind the pullback. Zain Vauda of Market Pulse by Oanda stated that there was a degree of selling as investors locked in gains after prices surged to roughly $5,249 per ounce. He also noted that the Trump administration's announcement of a fresh tariff may have provided short-term visibility regarding trade policy. This development appears to have influenced positioning decisions in the market. The tariff situation remains a central factor in shaping sentiment. The United States Supreme Court ruled that the reciprocal tariffs imposed by President Donald Trump were illegal. In response, President Trump imposed a flat 15% global tariff on all trading partners. The combination of a court ruling and a new tariff announcement has introduced both clarity and uncertainty into the trade environment. While the fresh tariff provided a defined policy measure, broader questions about the future direction of global trade remain unresolved. At the same time, uncertainty surrounding talks between the United States and Iran has continued to influence safe haven demand. Gold, traditionally viewed as a store of value during periods of economic or geopolitical instability, extended its upward move on Monday amid this backdrop. Market participants appear to believe that achieving clarity on the future of global trade could involve further legal challenges before the outlook becomes more certain. Currency movements have also played a significant role. On Monday, the US dollar slipped marginally against a basket of other currencies, supporting gold's advance. However, as the dollar strengthened in the subsequent session, bullion prices came under pressure. The inverse relationship between the US dollar and gold remains a consistent feature of the market, with currency strength often limiting upside in precious metals. Beyond spot and futures markets, exchange-traded funds tracking gold and silver reflected the broader price adjustments. Gold and silver ETFs declined by as much as 3% on Tuesday, after gold and silver futures on the multi-commodity exchange opened slightly weaker. Among gold-based funds, Grow Gold ETF, SBI Gold ETF, and HDFC Gold ETF each fell by about 3%. UTI Gold ETF declined roughly 2%, while most other gold ETFs showed limited movement. Silver ETFs also trended lower, with most recording losses of around 1%. Despite the short-term pullback, central bank demand continues to provide a structural backdrop for the gold market. As previously noted, central banks have collectively net purchased around 1,000 tons of gold per year for 4 consecutive years. Emerging market and middle-income economies have pursued diversification of reserves in response to geopolitical and fiscal pressures. Countries including Poland, Kazakhstan, Brazil, and India have expanded their holdings significantly, while substantial accumulation in China and Russia has continued through domestic channels. This combination of structural buying, currency shifts, geopolitical developments, and investor positioning has produced a dynamic trading environment. The recent rally marked the strongest surge in 3 weeks, while the subsequent decline reflects the market's sensitivity to changing inputs. Traders and investors are monitoring developments in U.S. trade policy, diplomatic engagements, and currency movements as they assess near-term direction. In the final segment, we will bring together the key developments from today's session and present a comprehensive summary of how gold and silver have responded to the latest economic and geopolitical events. Part 4. In summary, Gold and silver prices have experienced notable volatility this week, shaped by a combination of geopolitical developments, trade policy decisions, currency movements, and sustained institutional demand. In the United States, spot silver is currently trading in the range of approximately $28 to $30 per troy ounce, with 1 kilogram priced between roughly $900 and $950 based on international benchmarks, such as COMEX. These rates continue to update live and remain influenced by inflation trends and broader geopolitical factors. Earlier in the week, both metals recorded their strongest surge in 3 weeks. In the domestic spot market, silver rose sharply by 15,000 rupees per kilogram to reach 2,065,550 rupees per kilogram. Gold climbed by 3,262 rupees to 1,58,428 rupees per 10 grams. In overseas futures trading on COMEX, gold advanced by $96.61 per troy ounce to $5,177 per ounce, while silver futures gained 5.58% to $86.93 per ounce. The rally followed a weakening of the U.S. dollar after the United States Supreme Court ruled that the reciprocal tariffs imposed by President Donald Trump were illegal. In response to that ruling, President Donald Trump imposed a flat 15% global tariff on all trading partners. This development introduced a new phase in the trade policy environment. While the announcement provided a defined policy measure, broader uncertainty surrounding global trade remains. At the same time, uncertainty over talks between the United States and Iran has continued to support safe haven demand. Gold, widely regarded as a traditional safe haven asset, typically attracts interest during periods marked by economic or geopolitical instability. Following the strong rally, prices adjusted in subsequent sessions. Gold declined as traders locked in gains after the previous advance of more than 2%. Spot gold fell by 1.2% to $5,167.28 per ounce by 0538 GMT, ending a 4-day streak of gains after touching its highest level in more than 3 weeks. In further global trade, spot gold slipped 1.5% to $5,150.38 per ounce as of 0125 GMT. Spot silver also retreated, falling 3.1% to $85.50 per ounce after reaching a 2-week peak in the earlier rally. On the multi-commodity exchange, April 2026 gold futures declined by 983 rupees, or 0.55%, to 160,615 rupees per 10 grams. Silver futures for March 5, 2026 delivery fell by 1,006 rupees, or 0.3%, to 2,64,327 rupees per kilogram. Exchange-traded funds tracking gold and silver also recorded declines. Grow Gold ETF, SBI Gold ETF, and HDFC Gold ETF each dropped by about 3%, while UTI Gold ETF slipped roughly 2%. Most silver ETFs recorded losses of around 1%. Analyst commentary indicated that profit-taking contributed to the pullback, with investors locking in gains after prices surged to roughly $5,249 per ounce. The strengthening U.S. dollar also exerted downward pressure on bullion, reinforcing the inverse relationship often observed between the currency and precious metals. At the same time, central bank demand continues to serve as a structural pillar of the gold market. According to a report by Motilal Oswal Financial Services, central banks have collectively net purchased around 1,000 tons of gold per year for 4 consecutive years. Emerging market and middle-income economies have diversified reserves in response to geopolitical and fiscal pressures. Poland, Kazakhstan, Brazil, and India have significantly expanded their holdings, while substantial accumulation in China and Russia has continued through domestic channels. Market participants appear to believe that achieving clarity on the future direction of global trade may require additional time and potentially further legal developments. This ongoing uncertainty, combined with currency movements and geopolitical considerations, continues to shape investor behavior in both gold and silver markets. That concludes our comprehensive coverage of today's developments in gold and silver prices. We will continue to monitor movements across spot, futures, and exchange-traded markets as new information emerges. Thank you for watching.